Okay, hi, welcome everyone to my video on sources of financing, SMEs. My name is Chalwildy and you may contact me at wildy231@gmail.com if you have any questions on this video. So this video will be relevant to the CAT program and if not also known as the FIA program, the Foundation for Financial Management paper. It is also relevant to the ACCA paper F9. And let us have a look at what this topic is about. What do you understand by financing? What is financing? Now, financing simply, to put it in simple words, is money for the business. Well, when a business is started, there are many sources of finance. And let's look at what are the sources. Imagine if you are starting a business on your own. One of the most convenient and most accessible form of financing is owner financing, which means that the capital required, which is to be invested in the business, will come straight from the owner, and the amount available from owner financing depends a lot on his personal wealth. Yes, that's correct, personal wealth, which means that how much capital is available and how much funds that would be available for purpose of the business initial investment outlay really depends on his personal wealth, right? Of course, this may come a bit from his personal family members, sometimes even friends. But as you can see here, this thing about owner financing is quite limited because it really depends on, again, the owner's personal wealth. Well, looking on a bit further, the other possible sources of financing includes, which is not very difficult to guess, bank loans. Bank loans are very convenient. You could get a bank loan from people like your neighborhood bank. It could be from your neighborhood retail bank, right? Or it could be from one of those merchant banks if you are able to provide them requirement which is worth their trouble. So merchant banks wouldn't mind providing you some form of loan financing. Well, another very useful source of financing is overdraft. What is overdraft financing? Now, overdraft financing simply means that the bank gives you a facility which allows you to withdraw or use more than what your account has. Well, this facility comes with a limit, which means that while the bank would allow you to withdraw more than what your account has, the bank actually would place a limit of, say, maybe a certain amount, so you won't be able to draw down as much as you would want. And the moment when you hit the limit, or even before you hit the limit on the overdraft, the more you utilize, it also comes with a certain amount of interest cost, just like your bank loans, which comes with certain amounts of interest costs. Well, aside from this, businesses could consider another form of financing, which is leasing. Now, leasing is interesting because leasing enables a business to obtain use of an asset, right? And not just obtain the use of the asset, and also, but in getting the use of the asset, the business only has to pay rental, which is quite attractive. If you look at this arrangement, the benefit of this is that there is no need for a huge amount of down payment, and the business only needs to make sure that they have enough money to pay for the rentals. Well, the downside about leasing is that there is no ownership, right? So that's the downside about leasing. Of course, leasing can be divided into what you call the operating lease and also the finance lease. Both are of different natures. Now, and then of course, aside from leasing, then there is the more conventional method of financing for fixed asset purchases. We refer to that as hire purchase. Hire purchase is normally what people would go for when they want to purchase their own vehicle or purchase their own electrical appliances. And a hire purchase will normally involve an upfront down payment and also a certain number of installments over a certain number of months. That's hire purchase. The benefit of hire purchase, of course, is that they are able to stretch the payments over a certain period of time, and that helps the business to improve its liquidity while it tries to pay off the installments for the asset. In addition, as the business starts to operate, another form of financing which becomes available is trade credit. It's quite interesting. Trade credit gives the business a lot of flexibility, and at what cost? Well, the very interesting is that there is actually no financing costs. There is absolutely no interest cost. Well, trade credit is very flexible, but then it is limited by the amount. The amount that you could get from the suppliers, and suppliers are the people who give you the trade credit, well, they won't give you as much as you would want, although they can be flexible about it, and they wouldn't mind allowing you to take trade credit without paying interest, but there is a certain limit to how much you could get from trade credit. And trade credit in reality is quite a short-term form of financing, perhaps up to 30 days, 60, but it wouldn't be a very long-term form of financing. Right, looking on, then a business could also turn to government grants, right, for its financing needs, and if not, well, the company could also approach people like the venture capitalists. Now, venture capitalists basically are organizations, or it could be individuals. These are people with, or organizations with the financing, the capital, with massive amounts of capital, which they could invest in a business, and in return for investing in a business and providing that financial support, the venture capitalists would take up an equity stake in the business. And not just that, and they would also likely have a right to appoint their own director in the board of directors within the company where they have invested in. So venture capitalists is quite attractive because they have the financial ability to invest in the business. Quite attractive, but well, there are some downsides. As you can see here, they have the right to appoint their own director and ensure that their interests are taken care of. And there are some other conditions before venture capitalists invest in a business. And they wouldn't invest in any one business, okay, which we'll talk about in my subsequent videos. Well, one more very interesting party is the business angels. Business angels are very interesting, but like venture capitalists, business angels also bring in their personal wealth, and they invest in the business, and in return they take up an equity stake in the business. Quite interesting, but it can be quite difficult to get business angel financing because the nature of it is that it's quite an informal form of financing, not that easy to get, right? And also, even if you do get business angels to invest in a business and take up an equity stake in a business, business angels may tend to interfere a lot in the business operations. Well, again, that really depends on the business angel. And not only that, the amount of financial support and investments that can come from business angels would be also limited by their personal wealth. So do not assume that business angels will come in and they could invest as much as you would desire, right? So they do have some limitations in the amount of financing that they can bring along with them into the business. Well, another very interesting additional few more sources of financing is invoice discounting. Okay, this is a very useful form of financing because this simply means that if the business happens to have sold goods to a certain debtor, and while waiting for the debtor to pay up, if the business wouldn't want to wait for as long to collect the money from the debtor, the business has an option of selling the invoice at a discount, so-called selling the invoice at a discount to a discounter, and in return the business gets the collections in advance from the discounter, while in the meantime the debtor may take that certain credit period to pay up, and when the time comes when the debtor pays up, that funds will be used to pay back against the to what is owing to the invoice discounter, right? So invoice discounter is quite useful, especially if they are debtors, and then they are given a certain time period to pay up. Then well, these invoices could be sold to invoice discounters, so-called sold to the invoice discounters, right? Okay, and of course this is not cost free. There are certain fees and costs involved. And factoring basically is very similar to invoice discounting, except that in a factoring arrangement, the factor company will come in and they take over credit control management, and in return they help to manage the debtors, the sales ledger of the business, and they also help to chase for collections from customers. Well, the advantage of factoring is that they bring along with them expertise, the experience in recovering debts, and they are able to help the business provide enhanced liquidity, right, by providing cash advance back to the business based on whatever credit sales that have been achieved, right. So based on the amount of debtors that are available, then the amount of credit sales that have been achieved, then factor companies would provide a cash advance to the company based on the credit sale amounts. So it's quite attractive because the business no longer needs to wait for that 30-day or 60 days of credit period given to the debtors, right? And cash could be immediately obtained instead of having to wait for that 30-60 days to collect the amounts due from debtors. It's quite attractive. Well, it has its own downsides as well, and we'll see about that. Well, the last form of financing, also quite interesting, is retained earnings. Now, retained earnings, however, is more applicable for businesses which have been operating and they are able to generate profits. So basically what this means is that the business may have achieved profits, from year to year, and then those profits, after deducting the dividends, those amounts remaining is known as retained earnings. So of course, the better the business has achieved in terms of profits, the more retained earnings it has. But it also means that the amount that is also available may be quite severely limited, because again, it depends on the business performance in prior years. If the business has been doing poorly for the past years, then obviously there isn't much available. Alright, so with that, I have done a very quick walkthrough on what are the sources of financing available. Right, hope that you have found this video enjoyable, and I'll be talking more about the details of each of these forms of financing. Meantime, have a good day, and I'm Rodi Chia, and welcome to my channel on accounting and finance. Any questions, please do drop me a mail at wildy231@gmail.com. Have a great day. Drop me in your queries if you have any, and meantime, watch out for my videos on on some of these items. Have a good day. Meantime.